So here's Simon Gibson, our Chief Investment Officer, who will take you through today's programme, and I'll rejoin you later for the Q&A. Thank you, Simon.
Thanks very much, Joe. And as Joe said, welcome to everybody. Thanks for the rejoiners and those that are joining us for the first time. Most importantly today, of course, we trust you're all well. Want to reassure you that unlike as reported by the Financial Times 10 days ago, the folk at Mattioli Woods haven't stopped washing, using deodorant, or indeed forgetting to shave, although I do have a few colleagues who've chosen not to do the latter whilst working from home. We're going to start slightly differently for the first 45 seconds today, and we've got a brief poll for you to take part in. So Aidan is helping to run that in the background. If you could put that on screen for everybody now, please. And you can see it's a very straightforward question. How do you expect to consume or spend your money once lockdown is eased? Will you spend more than normal, as normal, or less than normal? Please vote by clicking on the little white circle next to each of the answers. How do you expect to consume or spend your money once lockdown is eased? More than normal, as normal, or less than normal? I'll give you a few seconds and we'll let Aidan judge when we've seen enough responses, and then we'll move on to the next slide. Thank you very much for taking part with that. We'll come back with the results on it a little later on. A quick update on Mattioli Woods, as I did last time. We have at the moment around 560 of our team working from home, with a modest population in the offices on a daily basis to deal with post checks and vital signing. As of yesterday, we have 76 of our colleagues who are either self-isolating, risk under the 12-week rule, or unwell. I'm pleased to say not too many are unwell. Staff well-being is as vital today as it was when we last spoke to you, and in normal conditions, of course. We've completed 24 well-being conferences for all staff. They've included the CEO, all the senior team, and people across all locations around the UK. Consultants, as many of you will know, continue to be in touch with all clients, and since we last presented, we've entered a new tax year, and we've already seen a flurry of new ISAs, top-up ISAs, and other tax planning being started, and in some cases even completed for the year. We will start all of our calls, as ever, with finding out how you are. All of the above means that we continue to be able to deliver a full service for clients, and very sadly, this does include continuing to look after those who don't have such good news. And I'm afraid that we're still dealing with COVID-19 deaths amongst our clientele, and we're now helping 9 families who have lost loved ones to this illness. This is a quick slide for you to just glance at. I'll highlight the key points. It's an internal slide that we put together through our operations team. To start with, please look at numbers 1 and 4, the population and the landmass. And here I'm comparing Italy, Spain, and Great Britain. The UK has the highest population and the lowest landmass. Spain, the opposite, which you can see at number 2. Spain, unfortunately, has the highest deaths per million. And this is very worrying for them, given that they have the lowest population to landmass ratio. And whilst there is no good news on this slide, for the UK, in the opposite position, in comparison, albeit not in actual terms, then we're okay on these numbers. Now, I don't want to dwell on this too much, and I want to get on with the rest of the presentation and introduce you to our first speaker in just a moment. But to let you know very briefly, and I'll come back later, what we're doing at Mattioli Woods, we remain pretty cautious. We've made a few decisions since we last saw you. We've increased some US Treasury exposure from some cash held across the defensive, cautious and balanced funds. We've reduced a little bit of Japanese and Asian equity at the very lowest level of our risk. And we've made many decisions since we last met, but the rest have all been to leave things as they are, to maintain the status quo. And we're not going to, or claiming to be able to know what's going to happen. There is so little clarity right now, and we believe that for that very reason, we should maintain a more defensive approach. That seems to make a lot of sense. Hence, we believe we've got the right strategy for you in place. I'd now like to introduce Tom Elliott. Tom is our senior investment strategist. And to introduce Tom, a quick line from Sun Tzu, who wrote The Art of War. He said, "Strategy without tactics is the slowest route to victory. Tactics without strategy is the noise before defeat." Tom, over to you.
Thank you, Simon. I'm Tom Elliott. I've been in the industry for 30 years, 18 as a market strategist, and I'm delighted to have joined Mattioli Woods. I'm also a visiting lecturer at King's College London in the Department of Political Economy. I'm going to talk for the next few minutes on thematic investing. What is it? Why do we do it? Thematic investing follows broad-based ideas and trends. These might be single industry ideas. They might be to do with behavioral behaviors amongst consumers and trends we're seeing, fashionable trends. It might also follow a broad macroeconomic trend. So it could be absolutely anything. The point is that it is not passively following a geographic-based approach to investing, but we are looking at drivers of future growth that offer solid investment returns. They can be multi-sector, they can be multi-country. One theme, for instance, we're interested in Asia, which fits into both of those categories. And they usually, but not always, refer to stock market investing. Other forms of theme investing might be via bonds or through direct investing, such as our interest in infrastructure as a theme. Indeed, our preferred investment themes currently include tech, healthcare, infrastructure, Asia, and global small cap. Why thematic investing? 3 reasons here. First of all, to ensure access to future growth and to avoid exposure to declining sectors. If you follow a country or a global index, you are by definition tied into declining, fading sectors. Surely one wants one's equity exposure to be in growth parts of the world and growth sectors. You want to be in the areas before they've necessarily been captured by geographic funds. And just as an example, perhaps as we do not particularly like oil and gas or tobaccos. And so by having a theme approach, we can avoid those sectors. Thematic investing also helps with portfolio diversification, by which I mean we can have a lower correlation with other global markets than if we just go into country stock markets. For instance, the S&P 500 has a correlation with the FTSE 100 of about 0.72, whereas the emerging market MSCI index has a correlation of about 0.6769. Not much of a difference, but it's actually quite significant over time. And many other themes that we invest in have much lower correlation. And so you achieve that diversification benefit through thematic investing. And finally, why do we invest in themes? It's because they are increasingly not only understood, but requested by clients as clients become more knowledgeable about this method of investing. And when it comes to geographic passive investing, had one taken that approach in the US or the UK in 1900, one would have found oneself in a portfolio in the US case about 35% rail, and in the UK just under 50%. They didn't know it then, but it was a declining sector. A thematic investor could have got into the new emerging industries such as retail, media, as they were growing, and not have been obliged to have held rail as it was declining. And indeed, the stock markets today, where we see no rail, but we see healthcare, tech, insurance, these are surely sectors that have good futures ahead of them, and thematic investors allow one to get on board these themes as they emerge, rather than once they've become large weightings in indices. We want to access growth as it's happening, not waiting for it to have happened. If you invest in a theme, in a geographic passive fund, you are by definition investing in where the growth has already happened. The US, for instance, is 58% by weighting in the MSCI All Countries World Index. China only has a 4% weighting. And yet, as the box on the right shows, of the 3% global growth that we saw to global GDP last year, China contributed 33%, a full third of that. The US, 14%. And you can see India contributed 13.5%. Now, if you take a geographic approach, India is a slither, but by taking a theme approach, and in our case, by looking at healthcare and infrastructure and Asia, that gives us exposure to India that you wouldn't get if you were to take a geographic approach. And my final slide is just looking at those correlations again. So the cigar-shaped circle around the column that shows the MSCI UK index, total return index, over the last 10 years, shows the correlations on the left column with all the different themes and various other geographic asset classes that we've selected. And let's just look at the correlation with the S&P 500, 0.74. It's a relatively high correlation, suggesting a movement not quite in lockstep with the FTSE 100, but very high. And as I said, the MSCI emerging markets, 0.69, that's less. And then you can see the columns for other of the themes that I've mentioned, and you can see they're much less, thereby demonstrating what I was saying earlier about being able to achieve not only better diversification of assets, but also taking on risk diversification. Thank you very much for listening to me while I've been talking about themes. Just to reiterate, we like themes because of the geographic diversification they give and the ability to get into new ideas as they're emerging. I'm now going to hand you back to Simon.
Thank you very much, Tom. Appreciate that. A quick headline as to why we think about themes there, ladies and gentlemen, and we will come back to themes again next month and more of that later on. We're now going to talk about one of those themes in particular, namely healthcare. I'd like to welcome and introduce you again to our colleague Richard Smith, who's an investment manager here at Mattioli Woods. Someone once said that healthcare should be a human right and not a commodity for sale. So there's plenty to think about, and of course it's very timely. So let's hand over to Richard and he'll take it from here.
Thank you for that introduction, Simon. Yes, I'm here to talk about healthcare, and I'm going to start really about talking about how it fits in with our thinking at Mattioli Woods, more generally speaking. If you all cast your minds back to the webinar we did 1 month ago, we were explaining how we think that we are in a low growth world for at least the medium term, possibly even for the long term now. So we are looking for opportunities which are attractive even against that poor lower growth backdrop. And we think that healthcare really fits the bill here. Healthcare has a major tailwind from the demographic and aging trends that we see across the globe. So it's not really a secret. I mean, everyone knows that populations are aging, both in the developed world and also in the emerging world nations as well. And this is creating a huge demand for healthcare services. Another attractive thing about healthcare is that it is a relatively defensive equity allocation. Yes, it was hit in March in the market sell-off, but it has recovered, broadly speaking, to be where it was before the coronavirus impact hit, which is better than can be said for the wider market, which is still somewhat down. We don't think in a short-termist manner when we're constructing portfolios for clients, but you know, the current crisis clearly has focused minds on the healthcare space, and we think that will create some renewed short-term interest and add a momentum element to the argument for healthcare investment. Another thing which I think is incredibly important is that the opportunity set within healthcare is heterogeneous. It's extremely diverse, the range of opportunities that are in there. And we'll just move on now to look at what they are. So where are the opportunities? Well, I think when most people think about healthcare, generally speaking, they think about the large cap pharmaceutical companies, the drug manufacturers, large, often mega cap, established companies, recurring revenue streams, very financially stable, probably dividend payers as well, and included in equity income portfolios. They are a very important part of the healthcare allocation. You've also got more risky biotechnology companies who are at the sort of cutting edge of gene and cell therapy investigations and treatments, also very important in an allocation. Medical devices is quite an interesting area. They are an extremely exciting stage of development, lots of new technology being employed there, and they're just at the right part of the innovation cycle. And then you've got more mundane opportunities in healthcare facilities and that sort of area. And as you can see, as I mentioned already, with several of those areas, they really are feeding into new technologies, and it fits very well with one of our other preferred themes, which is technology, which we're going to talk about, I believe, in next month's webinar session with you. Also in the healthcare arena, significant opportunities for mergers and acquisitions. There are some very exciting niche players out there that are smaller businesses, but they do become takeover targets regularly, particularly in this environment where more financially stable operators can actually come in and help them pursue their aims more quickly and against a more secure backdrop. So plenty of opportunities for investors and very diverse opportunities at that. So whenever we have any kind of theme or any investment idea, we do sort of have a devil's advocate type approach. Is what we do like to think could go wrong. So a few notes of caution. As I said earlier, it is not immune to wider market shocks. You know, certain areas of healthcare, such as medical devices in particular, were very badly hit a month or so ago because, of course, elective surgeries in the United States basically stopped. So the demand for lots of medical devices and equipment, you know, is immediately affected. So that has been badly affected. Healthcare is a politically sensitive sector, and you know, particularly in US election years, which I presume we find ourselves in this year, but of course, the election could be delayed. But you can expect to hear more and more chatter about drug affordability. This may become less of an issue now that the Democrats, Elizabeth Warren and Bernie Sanders, have exited the race. But I would still expect to hear some more chatter, and it does tend to weigh on sentiment and hold back share prices in a US election year. So perhaps over the summer we'll see a bit of a headwind from that for the sector. Aside from the US, we are seeing a lot of political support across the globe for healthcare systems. I think everyone's got a newfound respect for healthcare and what the health systems do. But this renewed interest from politicians could, of course, create its own pressures. You know, to what extent can companies be seen to be profiting from healthcare crises? You know, whoever finds the vaccine, assuming one does come along, we do expect one at one point for COVID-19. You know, to what extent can they be seen to make very large profits from their work? You know, there is going to be political pressure there. And even though we love the sector, generally speaking, you know, it doesn't mean that we abandon our focus on valuation and the financial strength of companies, because in the environment we find ourselves in now, if you don't have that financial robustness, you don't have a debt profile that you can manage, you stop being an interesting idea. So how do we go about investing in healthcare? Well, as with other areas that we invest in for clients in portfolios, we use the best external fund managers that we can. These are people with years of experience with the best performance track records. We vary the size of the allocations that we use across the risk spectrum for clients. So for more defensive clients, even though it can be considered a more defensive allocation, we have got a 2% exposure at the moment, and then we work all the way up to our more adventurous clients where we have an 8% allocation. Aside from varying the size of the allocation, we vary the nature of the allocation. So for more defensive and cautious clients, we will have, you know, a more defensively minded fund, probably got more of those larger pharmaceutical companies. When it comes to the more adventurous or growth-oriented clients, we introduce a bit of biotechnology exposure as well, because they have the risk appetite to take advantage of those opportunities. We do, as we do with all areas at Mattioli Woods, have specialist research analysts in-house. So that picture there of Lauren Wilson, she is our lead analyst in the sector. She's based in our Glasgow office. And so, you know, her job is to basically cover the space and come up with the best investment vehicles to fulfill our healthcare allocation. And just to reiterate this point, really, you know, we do, as with everything that we look at, we do question all our preferences and our assumptions just because we think healthcare is a good area for clients to be exposed to, it doesn't mean that we don't constantly question how we approach the sector. And with that, I'll hand you back to Simon. Thank you very much.
Thank you, Richard. Appreciate that. Let's move on to what we're currently thinking, and if I may, a little bit of looking back where we are and also looking forward. If we think about where we are today, we're of course in lockdown. We were encouraged to try herd immunity. We may yet see that that was a good or not so good thing. We'll find out in due course. What the government undoubtedly are hoping for is herd activity when we come out of lockdown. But it may not be that straightforward. We're going to have to maintain quite clearly social distancing. And we have anticipation and a hope that we will have a vaccine. And only after that, we believe, will we see normality. Now, Richard's referred to the vaccine. We have to hope and pray that we do find a vaccine. Vaccines are not always found for these viruses, and most of the experts are working hard, looking at a 12 to 18 month time frame, not a 3 to 6 to 9 week time frame. So we must be practical about that. And we do not think that the herd activity can therefore follow until we get to some degree of normality. Now, last time I spoke about the oil price, I highlighted the dual supply and demand shocks, and I said that the oil price needed to find a bottom. It may have done that. Indeed, at one point around about 10 days ago, 12 Andrex toilet rolls were more expensive than a barrel of US crude oil. It is an issue, and it's an issue because of the lack of economic activity. Last time I also asked if inflation might be a threat. I was lucky enough to be on a call with the Deputy Governor of the Bank of England about 10 days ago, and they release their next inflation report on Thursday of this week, on the 7th of May. And I don't blame him for this, by the way, but 10 days ago, he really did not know what was going to be in that report. We could anticipate, as he does, as his team do, that we'll have lower inflation in the short term because of that lower oil price and the lack of activity, but that we might see somewhat higher inflation in 12 to 18 months' time. I think that report will be well worth looking out for those of you that are interested. Because the shock to the economy has been somewhat self-induced, in other words, governments have chosen to take the lockdown approach, central banks and governments have been in a better position to respond more rapidly. And that's been very important. And certainly we've seen a recovery of sorts in some assets since we last spoke to you. But will it be enough? For example, can central banks and governments actually go shopping? Can they actually go into stores? Can they go into shops and restaurants and spend money? And of course, the answer to that is they can't. They've got plenty of liquidity that they've created. Our concern is that they cannot guarantee solvency. And we think this is quite a big issue. So how will consumers behave even when lockdown is lifted? We'll look at the poll result in just a second, but if I can quickly read to you from the Ipsos Mori poll of a somewhat bigger group of people who were polled on the 27th of April. At that time, 62% said they would be happy or generally happy to meet with friends and family outside their household, 33% not. Shopping in supermarkets, perhaps surprisingly, only 51% were comfortable, 39% were not. Moving on to going to your place of work, 27th of April, 49% would be comfortable, 35% not. But here are the two that really matter. Going to bars and restaurants, 29% comfortable, 61% not. At large public gatherings, sport or music events, 17% comfortable, 67% not. Aidan, could we have a look at the poll result at this point, please? Okay, well, thank you very much to everybody who's responded. We can see that 6% of you are positive, believe that you may be spending more than normal. Around about 60%, just under, will be spending as normal. That's neither of those probably a huge surprise, and therefore nor is the less than normal figure, 37%. So if we said 60 to 65%, the same as or more than normal, but with a only modest amount on the high end of that, we've got between 35 and 40% of this group who I would generally say were across a reasonable age spectrum, but certainly wouldn't cover the whole age spectrum of the consumers of the UK, who will be spending less than normal. Thanks very much for that, Aidan. And we've got a slide prepared just to show you what we think that looks like. I'll come back to that in a moment. First and foremost, I've got a few quotes for you here. The standard Lord Nelson, Winston Churchill. Maybe you've heard the odd Leo Tolstoy quote. I bet you don't often get George Michael and Wham quotes at your investment webinars, but what we'd all do to go dancing tonight. And indeed, we do all, of course, have to continue to do the right thing and choose life. Leo Tolstoy, when he was talking in Anna Karenina, he's not talking about global economies, but I like this quote because I think global economies are like families here. I think if we think of different economies, when things are good, when global growth is around, all families can be alike. But when growth is not around or a family is unhappy, it can quite often be unhappy in its own way. And look carefully for how different governments and different jurisdictions are dealing with different things. It is going to end up with more than a two-speed global economy at some point. I should put a word of warning with anything that's quoted from Lord Nelson, one of my personal heroes, because he also said every Englishman was obliged to hate the French. So we have to take some of this with a large pinch of different times salt. But what he's saying there is that sometimes to be safe, we have to be bold. And certainly that, I think, is what's happening at the moment. Winston Churchill's first quote here is really saying that we grow when we face and conquer opposition. And I believe that to be true. And I think we will see different times when we work out over the next few weeks and months of what we're going to do about COVID-19. The final one for me, though, is a favorite, and I've quoted this many, many times over the years, and I thought it was worth putting in that it was said in 1929, because this was Winston Churchill in 1929, not predicting Apple, not predicting go-to webinars or Teams or Zoom, but basically saying, keep it simple, stupid. Out of intense complexities, intense simplicities emerge. And I think we will see in many cases a simpler world, and we need to do what we can to take advantage of that. So back to the UK, here are some numbers from a combination of the Office of Budget Responsibilities, the Office for National Statistics, and the Bank of England, showing showing UK falls in GDP for, you can see the years down the right-hand side. And the suggestion that the potential economic impact for the UK is a shrinking of growth by 12.8%, or more than at any time, including after or during the two world wars or during the Depression. Primarily a US piece, I know, but nevertheless affected the globe. I think we must take this seriously, folks. The UK economy is in a very, very tough period. And whether you are a hairdresser, whether you are running a train company or a pub or a restaurant, whether you're in the tourist or hospitality industry, frankly, almost any industry is going to have some pressures. And we're very conscious of this. And having been underweight UK equity for some time, we continue to be so. However, for me, I think the US market is a place that is misjudging what is happening to US economic growth. And in particular, this slide and the table on the right-hand side, you can see that it says S&P 500, and in the column 2020, it says minus 17%. This is the consensus of a reduction in earnings from a group of analysts. They believe that earnings in 2020 will fall by 17%, but you can see they believe they will bounce back by 25% in 2021, leaving a net approximately 3% cumulative increase in earnings from January of this year, 2020, to December of next year, 2021. This has only recently been revised down to those numbers. As recently as only 2 weeks ago, those numbers were all more positive than they are. And I think they're still getting this badly wrong. And for us, the US market is an area of some concern. We think that that first column number could be quite a bit lower, and we think that the second one may not be as high, and that means that that final column may be a negative figure, in which case the US equity market is overpriced. We don't know, but we're using our judgment and looking carefully. Now, having said what's normal and what's not normal, here is a chart that I'd just like to spend a minute on, because this is normality. This is the major UK equities showing all the way back to 1986, and the grey bars show where the calendar year return ended. So you can see the far left-hand side, 1986, the market was up 22% over the course of the calendar year. But during that year, at one point it was down 9%. And those red dots show that during each of those years, how much of a fall was experienced. We probably all remember 2008, but remember 2009 as well, please. Having fallen 33%, at one point the market was down a further 23%. although it returned a total of 25% at the end of the year. We've put as far as we can get in the data for 2020, and you can see that it is so far not a good year, but it is relatively normal. It is showing that there is a fall in markets. Our concern is that that may be retested, but certainly not that we can anticipate a significant bar going up immediately thereafter. So with that, I'll hand you back to Joe. A quick reminder on the screen at the moment of our next two events, in case you weren't able to write them down earlier on. We're going to major on technology on the 4th of June, starting at 11:15, real assets on the 7th of July, starting at 2:15. And I'll hand you to Joe for the questions. Joe.
Thank you, Simon, and thank you to Tom and Richard also. We've had lots of questions come through, and I'll try to get through as many of those as we can before we wrap up at 3. So the first question that's come through is from a David, and he's asking, another $3 trillion US government borrowing announced yesterday. What is your assessment of further election motivated increases between now and the November election, and what might be the impact upon the world economy? And if I can address that question to Tom.
Well, that's a loaded question. Yes, $3 trillion is what the US Treasury announced yesterday will have to borrow to cover the federal government spending between April, May and June. That was actually largely projected. It's not a fresh spending commitment, and it fits into an overall borrowing this year, net borrowing deficit of perhaps 4.2, 4.5 trillion. It's particularly large this quarter because it's expected that furloughing costs and help to businesses will be particularly large over the next 3 months, but also because the income tax receipts have been delayed. The deadline has been extended now to July for taxpayers, so they've got to borrow an enormous amount. And it fits into a projected deficit that's going to go from about 5.8% of GDP before the crisis. It's worth noting the US was running one of the largest deficits in the Western world before the crisis, to as much as 15% of GDP this time next year. So a massive deficit. The key thing for America, and indeed for the world, is can America afford it? And it probably can. Unlike Italy and other highly indebted countries, the rate of growth, the long-term rate of growth in America is strong, and the Congressional Budget Office is forecasting from a hit this year of negative 5.6 to growth next year of 2.8. If you can have real growth of 2.8 next year, inflation say of 1, then that's nominal growth of 3.8%, and your funding costs are say 1% for 10-year, for example, then the golden rule of borrowing is that your nominal growth is higher than the cost of borrowing. Well, then the US is okay, in a way that Italy fundamentally isn't, and I have my concerns about the UK. The political aspect, well, Western democracies now are almost obliged to come in with huge amounts of fiscal spending and huge amounts of monetary easing, and they're raising the hurdle with every crisis. But I'd rather see that than not see it. I do not want to see starving people on the streets. And so I actually have no problem with this. And the effect on the world economy is good. America remains the world's largest economy. What is good for America in this case is good for the world. And I have absolutely no problem in supporting these fiscal and monetary stimuli. What I do have some concern about is, will we at some stage reach a point where the world savers have enough government debt for now? Thank you. They don't want to buy any more. And we see yields go up because of oversupply. We haven't reached there by any means, but that is my fear.
Thanks, Tom. So our next question is from Adam and Jackie. As some investment safe havens, such as oil, have been badly affected due to falling demand, are you planning any restructures to the makeup of existing portfolios? And if I could address that question to Simon. Simon, if you could pick that up.
Yes, thanks, Joe. Thanks to Adam and Jackie for that question. The oil price has very much been in the news over the last 5 weeks or so, and in particular the last 3 weeks. And it's fair to say that while some may have seen oil and maybe even the oil price via some sort of tracker as a safe haven. We haven't, and we haven't seen it as such. I think that perhaps the reason behind the question is oil has been seen as providing a significant chunk of the dividends for the UK market via, of course, Shell and BP, and dividends have often been seen as a safe haven and a bellwether in these circumstances. Well, we've seen that unfortunately that boat, if not having been sunk, has certainly been damaged below the waterline for the time being. We do have plenty of other what we think are relatively safe haven assets in place, amongst them US Treasuries, which I've referred to previously and Tom has just alluded to. One or two other assets like infrastructure that we feel they may be less exciting, but they've held up well. And lest we forget cash. Cash is king in these circumstances, and when there is very significant uncertainty, I don't mean a little uncertainty, I don't mean a bad couple of days on the market because of one or two company announcements, I mean something that frankly none of us have lived through, then maintaining a relatively healthy balance of cash either in portfolios or externally is healthy. Now, of course, at some point one wants to put that cash to work. We do also maintain some gold holdings, and we hold a few other elements within portfolios. But yes, cash could be king in the relatively short term, but be very conscious that one still has to remain invested to get a positive return. Cash may help us avoid some of the negatives, but it is not going to help us anytime soon to get positive returns. So it is a balance. We continue to be on the cautious side, and I don't think you're going to see us playing oil anytime soon, safe haven or otherwise.
Great, thank you, Simon. So our next question is from John. What are Mattioli Woods doing to identify opportunities for clients with surplus cash? Richard, could you pick this one up, please?
Yeah, sure. I suppose the boring answer to the question about what we do if people have got surplus cash is we firstly make sure that you know, they're making the most of all their ISA and pension allowances. But I'll try to give a more interesting answer than that. I mean, both from an asset allocation and a fund selection point of view, we are constantly looking for new opportunities. Our analysts that I referred earlier to, our research analysts, when they are reviewing a sector, they are now charged with coming up with a new investment idea, which may be rejected by everyone else, may be rejected by them, but they are now charged with coming up with a new investment idea. When you see the sort of falls that we've seen in markets, you know, it is natural to look at those areas which have been worst hit and to have a rethink and to say, well, is there now an opportunity based on valuation? You know, whether it's, you know, emerging markets or perhaps areas of the high yield market or something like that. But the truth is, I think we think we've looked at pretty much the whole scope of investments, and there aren't that many compelling opportunities out there once you actually start to look at things from a risk reward basis. So we're not seeing many new ideas. Simon referred earlier to the fact we've added a few more US Treasuries into the portfolios. We'll continue looking, but at the moment we don't really see anything compelling, as I say. That doesn't mean we're sitting on cash. Obviously, we're still we would still put clients' cash into the portfolios as they're currently constructed. In terms of compelling new opportunities, there's not a lot out there at the moment, but we'll keep looking.
And Joe, I could perhaps just add to that, if I may. I think the last couple of words that Richard's said are vital. These conditions are, of course, unusual. We're in uncharted waters. The word unique is used too much, but we're in unique circumstances right now for everybody who is working and dealing with this. The circumstances are unique, but we're always looking in normal circumstances. We're always interested. We're not sat around thinking we've got it, we've nailed it, we've got things as they are, but we start with strategy and then we overlay tactics. And as I alluded to when I introduced Tom earlier on, I think that combination is important. You know, you cannot do one without the other. It becomes almost equally dangerous. So we do continue to look. We're also kicking the tires of everything we own at the moment. So even if we feel we've got the asset allocation right, then the underlying fund or fund manager or instrument is being really carefully looked at, and that may involve some modest change in the background. But it is a constant piece of work, not just one that we're starting to do now.
Great, thanks, Simon. So my next question is posed by Derek. So thank you, Derek, for this question. It's got a few components to it. With REIT valuation dropping by over 25%, is the current REIT valuation reflective of the current COVID-19 restrictions on business only? Do you see rental income affected? When do you expect to see valuations increase? Simon, would you be okay to pick that one up, please?
Yes, thanks, Joe. We had Richard Shepherd-Cross speaking last month, and he'll be speaking again in a couple of months' time to update us on property and infrastructure at that time, which hopefully will be of interest to people. I think with regard to the custodian REIT in particular, I'll just remind those of you that are invested that it has always taken a regional approach. It's also taken a relatively small lot size approach, and it's not heavily involved in the retail market. But in these conditions, clearly, things are somewhat different to the norm. In terms of valuations, I'm not the specialist here, but we know that valuers are effectively taking a best endeavours approach to valuations. We've seen, for example, within the REIT and elsewhere, that some businesses have met and kept and retained their payments for the March quarter. Others have come back to us and plenty of other properties out there and plenty of other landlords and are looking for 3, 6 or 9 month deferrals of those payments. And I think that's understandable in these conditions. So one would expect across the real estate universe that the income will be lower over the course of this year. So that's the answer to, do we see rental income being affected? I think we do. We're also seeing a desire for certain people to work from home. We've also internally got plenty of people who are desperate to get back into offices. So I don't think we've seen the death of commercial property, but I think we will see a slightly different environment when we look out 1, 2 or 3 years ahead. Nevertheless, I think expectations for valuation increases will follow. As to when, I don't think Richard Shepherd-Cross would tell you. I'm certainly not about to give you a date, a month, or frankly even a quarter, but I think so much will revolve around what I said earlier on, and that is getting a vaccine. If we do see a vaccine, we can head off a second wave, or we can try and reduce some of the social distancing measures. But rest assured, some things have changed for well and good, and other things will change back perhaps to what we've been used to. I think commercial property will sit between those two areas. I hope that's useful, but dial in a couple of months' time, and Richard will cover that in more detail.
Great, thank you, Simon. And we are drawing very quickly to the end of our session, but there's some questions that have come through that I think I could probably answer, because they relate to whether people will get invites to the next set of events that we're running, and absolutely you will. So if you've registered today, we will notify you by email to invite you to register for the next webinar that we're holding. Just to reiterate, that's on Thursday, the 4th of June at 11:15. And we look forward to seeing you with us again once more. Thank you, and thank you to all the speakers today.